Hello, everyone. This is AJ with FBS Securities, bringing you a quick market update. I just wanted to cover some levels, as well as my overall thoughts on some of the action that has unfolded the past 24 hours. So we'll get right into it. First and foremost, this information is for educational and informational purposes only, should not be considered investment and financial advice. So the main drama that sort of unwound yesterday was the market was pricing in lower tariff and reciprocal tariffs on other countries. I think anywhere from 10 to 20% was sort of what the consensus was. And whenever Trump came out yesterday, the list was anything from 50 to 70, even up to 80 and 90% tariffs on some specific countries. So that really threw the market for a very large shocker. And of course, today was the worst performing day since March of 2020. So since the COVID crash, S&P was down just almost 5% and Nasdaq was down just north of 5%. But now the S&P is down almost a little more 8% than the year, and Nasdaq is just shy of 12%. But a very sudden and a very knee-jerk reaction to the downside. I usually look at, I was mentioning to some of my contacts that I have that, I think everyone was sort of looking as yesterday to be the bottom and a relief bounce for the overall market. I like to look at it from a contrarian perspective, right? So if everyone's sort of expecting the markets to bottom on April, or sorry, on yesterday, then I personally didn't think that would happen. So, and of course, now we're looking at the market almost 5% lower from yesterday as well. But, just have to watch out for some levels. And I do believe that Trump will start to negotiate, or rather, the countries that have a higher tariff amount will start to negotiate with him, and they'll bring that whatever the tariff rate, if any, that goes through more into a more normal range. And so we should expect to see some sort of a rebound soon. But for now, I mean, again, a very ugly session and ugly start to the year as well. But there have been some pockets of strength. I think gold has been the best one so far. I was up almost 30% on the year, and KWEB. I did have KWEB in some of my sector rotation ETFs, and I did sell that last week just because I thought the trade was lower overextended. But it was a pretty good trade, and of course some low volatility ETFs and some very defensive sectors as well. So far this year, ARK and semis have led the downside. ARK is down. ARK and semis are almost down 20%. And the Magnificent Seven are almost down 19%. So again, very ugly start to the year, but um, I'll point out some levels and see how what we can go from there. So if you're looking at the markets on a longer term perspective, I kind of went back and marked any of the more significant drops, or anything more than around 8 to 10%. So as you can see, I mean, there's always some news or some sort of drama associated with a lot of these drops, whether it's tariffs, whether it's Feds, whether it's any sort of recessionary fears. A lot of these drops are coincided with some negative news event. Now, of course, aside from 2020, or sorry, 2008, when the global financial crisis happened, if you're looking at anything past that, anything in the 10 to 15% range, has been pretty normal to kind of see throughout the years. And of course, you look at the COVID crash, that was, a 35% correction, and then the bear market of 2022. So, just from peak to trough, anything in the 10 to 15% range seems pretty, I'm not gonna say it's normal, but it should be sort of expected. And it seems to be more in the pattern of how the market fluctuates, right? I wish the markets could go straight up, but that's just not how it's done. And usually, whenever the markets are down 10, 15%, this is kind of where investors are a little bit more fearful. That's kind of the crowd sorry, that's kind of the mentality of retail traders where they want to only invest when the markets are doing well and don't want to take advantage of the dip opportunities and whatnot. Now, I'm not saying to go and buy the dip with both hands, but if you're looking at it from an overall perspective, markets are down or S&P is down just north of 12%, it might not be a bad idea to at least allocate a small percentage of capital if you are managing your own money into your accounts, because again, you're getting a good opportunity versus say buying in Feb or January of the year, right? So I just wanted to add a little bit of context to this. I think as an investor, your time frame horizon is the most important aspect. Are you looking 10, 15, 20, 25 years out? If that's the case, then anything where you're getting a 10, 15, or even a 20% pullback into the corrective range is always or usually a good time to at least ease into the market when your time frame horizon is a very long-term horizon. Again, not giving out any advice or recommendations, but when you're looking at it from a historic perspective, and like I mentioned from the previous sort of pullbacks, these have been a very good buying opportunities. Now, can the market go lower? They can absolutely go lower, but that's why easing into the market where you're at least consistently adding and irrespective of what's happening, your time frame again is on a longer term perspective. But on a short term thing, of course, there would be some fluctuations. But on the long term, that's kind of what you should be looking at as an investor. Just wanted to add that quick context. So from a levels perspective, we do have, I know this might be quite a bit. Let me remove some levels. So we do have this strong trend line support. There's a couple of trend lines, but markets are kind of hanging in right there. And I did mention in a previous video that we do have this gap fill lower, right around this 533 to 536 area, and markets, and we're just right, just right there just above it. But more importantly, we also have this 50% retracement from a fib, from a previous fib that I was watching, which kind of aligns with the area as well. Now, I'm not too confident to say that these levels might hold. Again, when the market is in a complete sell-off mode, there usually will be no safe haven to hold, right? So, I mean, if you looked at gold today, and if you looked at crude, dollar index, a lot of these defensive sort of sectors all got sold off as well. So typically on days like these, it's a full wide market panic at that point, right? So I'm not saying, or I don't really have too much confidence that this level will hold, but it is something that I'll be watching for the open. Now, the next sort of mark that I would be watching is anything in the 15% pullback. So this would basically be coming into, if you're looking at this current lows, we're looking at almost 523 levels, and this kind of coincides with this other gap that we had as well. But that's kind of the 10% to 15% correction levels or some that I like to watch on any sort of downside. But again, like I said, these opportunities and these pullbacks will always be there in the markets. Now, when it comes to the time frame wise, this is pretty interesting. If you're looking at let's say this previous one in July of 23. This lasted for almost 3 months, this sort of corrective phase. And if we look at, where is the other one was back in 2018. If you looked at, sorry, if you looked at it from 2018, so this, whenever the FOMC, and this was the Trump and Fed cut drama. So this was basically from uh, sorry, this is from September to December. And then if you looked at this as well, right past the COVID highs. So this again was almost a 3 month sort of ordeal. And even this right here was just around a 3 month ordeal. So it seems to be that anything on the corrective phase can last anywhere in that 3 month sort of time frame. So just kind of, watching that as well. Hopefully it's a little bit quicker, but just based off some of the previous stuff, that's kind of looks to be anything, looks to be a little bit in that range. But if that does fail, then I would anticipate the markets to come back into this full 50% retracement from the 2022 lows, which is coming into around 481. This also perfectly coincides with the previous highs of 2021. If you can see from the lows of 2020 to the highs of 2021, we hit the 50% retracement perfectly to the T. So now, if we again, just the level that I'm watching, if we come back from 2020, sorry, the lows of 2022 to the highs of 25, then that level also perfectly aligns. I don't think we will see that level anytime soon. but just something that you should be mindful as well. Now, when it comes to what I was initially watching for this rebound was the 50% retracement for the market. So if you have a bearish fib right here, this 50% mark was technically around 581. It didn't hit on the S&P, but it did hit on the futures. So if you look at the futures level from the highs to the lows, oops, this 50% mark was hit almost perfectly to the T. Now that target, whenever that does hit, is this blue, sorry, this green area. So it's 53, 54 would be that first target whenever that level gets hit. So again, it's kind of coinciding into this 5400, which is another 50% fib retracement. I mean, this is a 50 wide point range, but this would be somewhere where hopefully we can expect to see a relief bounce and at least get a little bit relief in the market. And like I said, I think it'll be more news driven, especially given the fact that Trump will be negotiating with a lot of these countries over the weekend. So yeah, that's all. That's all I have. I think, or sorry, all I have for the levels wise. But also something else to be that I'm watching. So technically. Uh, if you look at it from this range perspective, so you have this large base that's been forming. Whenever we have this base, the typical rule is that whatever the length of this base is, that should be the first target, either if it breaks to the upside or downside. Now, the first target right here has kind of been hit, which is this 540, 541 level. Now, if it does start to get even lower, then that second target would be somewhere into the 506. Again, it's getting a little bit closer to that lower level. Yeah, so typically we use 1x of that range, which gives us a good target. We already hit that target, but again, like I said, we're kind of stalling into some of these fib levels. So just something to watch overall. And now I'll kind of go over some of my sectors that I watch. So again, if we look at it from a time frame perspective, I think basically since beginning of or mid-Feb, a lot of the defensive sectors did start to show some momentum. And then as you can see, now the defensive sectors are leading, and now we're kind of again, I'm monitoring some of the more risk on sector, right? So Magnificent Seven software, we have semis right here in XLK, so the technology sector. It might be another couple of weeks before this is kind of set up, but at least the defensive sectors are leading and whatnot. But like I said, typically when you have these broad market sell-offs, there's no safe sector, right? Everything will kind of get hit proportionately and whatnot. So. Yeah, just wanted to provide a quick update and just show some levels and just wanted to show the overall market dynamics as well, right? Anything 10, 15 percent has been pretty not normal, but it has been it's not an uncommon occurrence to see those sort of corrections and whatnot. But yeah, that's all I have. I hope you enjoy your night. Thank you.